Hi, I'm Dr. Humaira Shahid, and I'm here to explain some properties of plant assets, natural resources, and intangible assets to you. This is chapter number 10 for Introduction to Financial Accounting 2, and we have several learning objectives to cover under this topic. So, here are five major learning objectives we will be covering for plant assets, natural resources, and intangible assets. Starting with learning objective number one, which says that how to regard the plant assets, or you can say what is the accounting for plant assets expenditures. Second learning objective, we'll be talking about depreciation methods for the plant assets. In this recording, you will be looking into only the first two learning objectives. In order to check learning objective number 3, 4, and 5, you need to listen to the next recording for this lesson. So, what are plant assets? How do you describe them? What are the features of plant assets? So, number one, they are resources. Resources means we use them for our businesses. They help us in future. And these resources have physical substance. Physical substance means they are tangible in nature. They have a definite size or shape. You can touch or see that. Second important property for the plant assets is that we use them in the operations of the business. We don't buy them to sell them to someone else. We buy them because we want to use them for our business. The most common example for the plant asset, let's talk about a van or a bus which an organization is having to provide the pick and drop services to its staff. So this bus or van will be considered as equipment under plant assets. So it is a plant asset because you're using this bus for your business. You did not purchase it so that you can sell it. You purchase it because you want to use it. If there is a company who is making vans or who is making these buses, and they make it and then they sell it to their customers, so for such company, these buses or vans are not considered as plant assets because you are making them so that you can sell them to the customers. And the point number 3, which is not intended for sale to the customer, is not met in this scenario. So if you are purchasing an asset for your business use, that's a plant asset. But if you are making an asset or purchasing an asset to resell it or to sell it to the customer, that's not a plant asset. One more important feature for the plant asset is that they are having a longer life. They are not like current assets who will be used within a time frame of 1 year or accounting cycle. They are actually going to be used by the company for a number of years. So if all these features are met, we will categorize an asset as the plant asset. We have some names for the plant assets. We call them plant assets. We call them property, plant, and equipment. Sometimes we refer them as plant and equipment. Sometimes we refer them as fixed assets. How many plant assets a company keeps or how much the plant assets a company have, it depends on the industry in which the company is operating. Those companies who needs huge amount of assets to operate their business, they will be of course keeping more plant assets as compared to those companies who don't manufacture or anything, who actually give the services to the customers. So here's an example for you that Southwest Airline, out of their total assets, they have 77% assets as plant assets. Wendy has lesser than the Southwest Airline. If you see the last company, that's Microsoft Corporation, which mainly deals with the softwares. So they have only 3% of plant asset because they don't manufacture anything. How do I calculate the value or the cost of plant asset? When I say cost of plant asset, I mean to say the amount which I will be putting in my balance sheet against plant asset. Like let's suppose if I have land, how much value I'm going to put for the land. If I have building, how much value I'm going to put for the building in the balance sheet. So for that purpose, we need to calculate the cost of these plant assets. And for this purpose, we follow historical cost principle. As its name says that, historical, history. So all those costs which you incur until and unless the asset is ready for its use, we add all those costs, and then finally we come up with the cost of our plant asset. So historical cost principle requires that the company record plant assets at their cost. So what is the cost? Cost consists of all the expenditures which are necessary to acquire an asset and make it ready for its intended use. If you purchase an asset but you cannot use it because it's not ready yet, you have to do its installation, then the cost is not complete. You have to do the installation, you have to do the testing until and unless the asset is ready for use. Whatever costs you have incurred, you're going to add all of them, and then you will be mentioning it in front of your plant asset. So let's take few examples of the plant assets and try to identify how to calculate their cost, starting with land. Land is the major plant asset which companies have. And if you want to calculate the cost of the plant asset, don't forget the rule. The rule is you will be adding all the necessary cost which you need to incur, which you need to make in order to make the land ready for its use. So you're going to add all of them. So more costs are there, they're going to be added to the land account. They will increase the land cost. Land is an asset, and when asset increase, we debit them. So that's why we wrote here intended use increase or debit the land account. What could be the possible examples of these costs? So of course the purchase price of the land. Then the land was in the name of old owner. You have to transfer its title to your name, and you have to pay the attorney fee for that purpose. So these costs, title transfer and attorney fee, is known as closing cost. So you pay closing cost. Then the real estate company or real estate agent who has helped you in finding this land, he'll be charging you a commission. So real estate broker commission is also going to be added into the cost of land. And then accrued property taxes. Any property taxes which are accrued, which are payable on this land, if you being purchaser accept that I will be paying it or my company will be paying it, then add them into the cost of the land. But if seller has to clear all those taxes, then it's not your cost. And other liens on the land. What could be the other lien, other charges on this land? Maybe the old owner has taken a loan against this land. He might have given this land as a security to the bank, and he might have borrowed a loan. He would have paid all the installments of the loan except the last two installments. So banks still have lien on this land for the amount of those two installments. If you agree that you will be paying these installments, then you have to add it into the cost of the land. But if seller has to clear all these costs, then it's not your cost. So these are the basic costs which are added into the land account, and they make up together the cost for the land. Let's take an example for this. Hayes Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is raised, means the old warehouse was there which was removed, at a net cost of $6,000. Net means there is some calculation which we made, that's why we get this net cost. So what are the calculations? Look at the bracket. $7,500 in cost means in order to remove this warehouse, you paid to the company that who has removed this warehouse $7,500. When they broke down this warehouse, there was some scrap which you was able to sell. So less $1,500 proceeds. You get the money from the salvaged material by selling that scrap value of the warehouse. So actually you spent $7,500 to remove the warehouse, but at the same time by selling the scrap you was able to get the money $1,500. So net cost which actually you have incurred for the warehouse was $6,000. Additional expenditures are attorney fee, you paid $1,000, and the real estate broker's commission $8,000. So all these four costs his company has paid in order to get this land. He has to pay them, then he can use the land. So he will be adding all these costs together: cash price of the property, net removal value or net cost of the warehouse removal, which is 6,000, attorney fee 1,000, and real estate broker commission 8,000. So together total cost for the land is $115,000. Let's move towards the second category of the plant asset, which is known as land improvement. Land improvements are additions or some structural changes you made to the land. They are other than the building. They are not as building, like some shades, some parking lots. So these things are considered as land improvements. So whatever costs you incur in order to do these land improvements, until and unless the improvements are ready for use, you're going to add up all those costs, and you will be mentioning against the asset of land improvement. The possible examples of land improvements are driveways, parking lots, some fences you install to protect your land, some landscaping to make the land attractive, underground sprinkler to water the plants. So all these are the examples of land improvements. And if you see, all of them have a life. After that, they are not usable. Like driveways will fade away, parking lots will need painting and renewal, fences will get broke, landscaping will be either damaged or it need renewal, underground sprinkler has a life. After that, they are not usable. So that's why all of them have limited useful life, and you're going to expense them. You're going to calculate the depreciation for them over their useful life, just like you do for other assets, other plant assets. Another category of plant asset is known as building. So it includes all the costs which are related. Either you are purchasing a ready to use building, so whatever cost you are incurring to purchase that building, they will be added up, and then you will mention them as a cost of building. Or if you construct the building, whatever cost you incur for the construction of the building, and then the building is ready for use, whatever costs are till for that time period, you're going to add them up, and then you will mention them as the cost for building. Let's start with the building which is ready for use, a purchase building. So in that case, whatever purchase price you are paying for the building, that one, then the closing cost means attorney fee and the title transfer, real estate broker commission, the broker who helped you in purchasing the building. All these costs you are going to add up. If you don't want to do anything else, you want to now you have purchased the building, now you will be using it, so these costs will be added. But most of the time we do remodeling, or we do some renovation in the building, like painting, removing the broken stuff, putting the new stuff, installation of roof or floors, or some electric appliances, or doing some wiring, or doing some plumbing work. All of these costs, if you are incurring, you are also going to do them, but you are also going to add them into the cost of your building. So altogether, these will be the cost of building. What if you are constructing a building? Then in that case, the construction company who will be constructing the building for you, they will charge you a contract price. So that contract price, plus if you are doing the architect work by yourself, means you are hiring another company to do the architect or interior for you, so their fee, and taking the permit from the government that we want to construct this type of building in this particular area, so that permit needs to be purchased, and then excavation costs for the building. All these costs, you are going to add them up, and then that will be the constructed building cost, which you will be putting in your balance sheet. Let's move towards another type of plant asset, which is equipment. Equipment includes all those assets which equip your staff to work efficiently. It helps your staff in doing the work. So it includes all the costs incurred in acquiring the equipment and preparing it for its use. Usually equipments, when you buy them, they are disassembled. You have to assemble them, you have to install them. So all these things, when you will be doing, if you are paying something, you are going to charge it against the cost of equipment. So what are the typical costs which are included into the cost of equipment? We start from the purchase price. Then if there are some sales taxes which are imposed on the purchase of such equipment, You being buyer usually pay the sales taxes, so you're going to add them. You purchase the equipment, right? But it's still not in your location, it's with the seller. You have to bring it to your location, so for that purpose you have to pay the freight charges. And then on the way, if something happens to the equipment, who will be responsible for that? Are you going to pay again and purchase again from the seller, or seller will be giving you a new piece of equipment? Both are not feasible conditions, right? Because both of you are not responsible for the damage. So in that case, for such things, we do insurance in transit. Transit means on the way. So this insurance is done for the equipment, that if something happens to the equipment on the way, then insurance company will be paying for it. So if buyer pays insurance in transit, means purchaser, means you pay insurance in transit, then you are going to add it into the cost of equipment. But if seller pays it, then ignore it. It's not your cost. Then the equipment is at your location, but it's disassembled. You have to arrange it, you have to assemble it. Usually the seller provides this service against some extra charges. So you want assembling of the machine. Some machinery, some equipment needs proper installation. Its pipes, its boundaries, its base should be fixed on some particular places. So the installation cost. And once the machine is assembled, you have installed it, you perform testing. Some items are produced just to test that the machine is functioning properly. So those items material cost, that testing cost, is also going to be added into the value of equipment. So if you assemble all these costs together, then that is considered as the cost of equipment. We have an example with us. Lennart Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales taxes, $1,320. They also did painting and lettering for $500, means they painted the truck with their name. Motor vehicle license. Motor vehicle license is the license which you obtain from the government that this motor can ride on the roads. So if there is some license for your vehicle, that is renewable every year. So that's not one time cost, or that's not the cost which is related to the purchase of this truck. You can use the truck, and when 1 year is over, you can go for the motor license renewal. So this is an expense. This is not the cost to be added into the truck. And then a 3 years accident insurance policy. Just few minutes back, I told you about insurance in transit. That's one-time insurance, and this insurance is in transit, means when the equipment is coming to your location, if something happens, then this insurance is used. But this one, 3-year accident insurance policy, it's the renewable stuff, because your truck will be on the road taking or bringing the products. So in that case, you have to have the insurance for accident purpose, and it's renewable. So you are purchasing 3 years in advance. So this is prepaid insurance. That's a current asset, 1,600. So what we are supposed to do? We are supposed to calculate the cost of this delivery truck. So we'll be adding the cash price, which is $22,000. We will be adding the sales taxes, which is $1,320. We will also add the cost for the painting and lettering, which is $500. So altogether, the cost for the delivery truck is $23,820. But do remember, you also incurred the cost of license expense, which is $80, and you also purchased the prepaid insurance, $1,600. So when you record the journal entry, you not only record the journal entry for the purchase of equipment, plus you also paid license expense, plus you also paid prepaid insurance. So altogether you paid the cash. So the journal entry to record these costs will be equipment, which we just calculated, 23,820. So equipment gets debit, 23,820. We have license expense, which is $80. We have prepaid insurance, 1,600, which is current asset. For all of them, we paid cash, 25,500. Now, since we are talking about equipment needs repair and maintenance. Why do we do repair and maintenance? Because we want to maintain their operating efficiency and we want to use them throughout their productive life. So these ordinary repairs are needed. They are regular in nature. If you don't do ordinary repairs, the asset will not be maintained and its production efficiency will be affected. Its efficiency will be affected. So whenever you conduct, you incur any such expenditures, you are going to record them as expenses, repair expenses, maintenance and repair expenses. And expenses, when they increase, we debit them. So ordinary repairs which are of usual nature, which you incur in order to maintain the operating efficiency and the productive life of the equipment, you debit them into the maintenance and repair expense account. And such type of expenditures which are ordinary in nature, we call them revenue expenditure, because they are reflected in income statement followed by revenues. Right? You already studied about expense recognition principle. Expenses should be recognized in the period in which they help in obtaining the revenue. Right? So that's why expenses are considered as revenue expenditures and they are reported in income statement. Sometimes company performs some additions or they do some improvements cost. Why they do that? Because they want to increase the operating efficiency, not maintain. Maintain is for ordinary. They want to increase the operating efficiency or the productivity or the useful life of the asset. So these additions and improvements, because they increase the life or they increase the efficiency or they increase the productivity, so we add them into the cost of the asset itself. So we debit them, we add them into the plant asset which is affected. Let me give you an example for this. For example, your company, because we just took the example of a truck, so let's continue with the same. So if your company purchases a truck and it uses it, you know that truck needs filter change, truck needs few oil change in its engine. So these type of repairs are ordinary in nature because you have to do it. If you don't do it, efficiency of the truck is affected. So this is your ordinary repair for the truck. Okay. What if your company is having the same truck but you add some wrapping or the covering on the seats, or you add some additional pieces in this truck so that its life improves, like let's suppose adding a slider on the back side of the truck so that loading and unloading becomes easy, so the truck life will be more. Why? Because the truck will not get damaged because of tampered by this heavy stuff which is being transferred by it. So if you add such things which improves or which increases the operating efficiency of the assets, you're going to add them into the cost of the asset, and we call such cost as capital expenditures. We call such expenses as capital expenditures. Why? Because we capitalize them, we add them into the cost of the assets. So expenditures are of two categories: revenue expenditures and capital expenditures. Revenue expenditures are also known as expenses. Capital expenditures are also known as non-current assets. Okay, have a look at this case. It's about Volcon. What does this company do? They categorize one of the capital expenditure as a they categorize one revenue expenditure as a capital expenditure. Means instead of putting an item as an expense, they have added it into the asset side. So their profits were more, their profits were boosted up, which was not true picture. So it is considered as fraud. So proper classification of revenue and capital expenditure is very important. This is a do it exercise. It's about Dermon Heating and Cooling Company. They purchased a delivery truck for $15,000 cash. Plus, they paid sales taxes $900, and the delivery cost means transportation cost for this truck was $500. The buyer also paid $200 for painting and lettering. $600 for annual insurance policy. So this is insurance annual. It's not in transit, so we are not going to add it. And $80 for the motor vehicle license insurance. Again, license insurance is renewable, so we are not going to add it. So they say that explain how each cost would be accounted for. So the first cost, which is purchase price $15,000, then the sales tax, then the delivery cost, then the painting and lettering cost. These costs are going to be added into the cost of the truck, and together they are $16,600. Your insurance policy is going to be added as expense. Why? Because it's annual. It's not 3 years annual. If 3 years, that's prepaid. This one is one time for 1 year payment. Next year you have to pay again. So it's not prepaid, it's directly insurance expense. And $80 motor vehicle license insurance, that also an expense. So they will be reported in your income statement under expenses head. Let's look at the second learning objective, which is how to calculate the depreciation for the plant assets. Before moving on, let's see what is depreciation. So depreciation, it's a process of allocation. What allocation? You allocate the cost of the plant assets to the expense account. So you depreciate the asset and you allocate that depreciation to the expense account, which is depreciation expense. How long? Over the useful or the service life of the asset. And make sure you use a rational. Rational means a method which human mind can accept. A logical method, rational and systematic manner. There is a system, there is a proper procedure to carry out that method. So here rational and systematic is focusing on the depreciation methods we use. So basically, depreciation is a process of allocation to allocate the cost of the plant asset to the expense account over its useful life in a rational and a systematic manner. Use one of the depreciation method. Do remember, it's a cost allocation method. It's not asset valuation method. Asset valuation method is another story. We value the assets at the end of the year. So you will be learning this in upcoming learning objectives of this chapter, of this book. Cost allocation means allocate the cost. Pick up some part of the cost and put it in the expense account. It applies on all those assets which has limited useful life, like land improvements, like building, like equipment, but not land, because land does not have a limited life. Why we depreciate the asset? Because the revenue producing ability of the asset decreases over its useful life. As we use the asset, its revenue producing ability comes to an end once its useful life comes to an end. So we have to show every year how much efficiency is affected, and that will be allocated to the expense account under depreciation head. We have some factors, or you can say we need some variables to calculate the cost of to calculate the depreciation expense. So what are those factors? We need cost. What is cost? Just now in learning objective number 1, we learned how to calculate the cost. So the formula was all the expenditures which are necessary to purchase an asset and make it ready for its use. Right? This is what we were doing. We also need useful life. How long this asset can help us in production or help us in our business. So when we calculate the useful life, it's an estimate, it's an idea, it's a guess. So it's an estimate of expected life. How do you guess this idea? It is based on how frequently it needs repair and maintenance, how long it can provide us services, and how quickly it can obsolete, vulnerability to obsolescence. So you have to know these factors, and based on this you decide about the useful life of the asset. And it's an estimate. Estimates means probability, guesses, and guess could change later on. Salvage value is the value of the scrap you can get at the end of the useful life of the asset. Now the body of the asset, the scrap of the asset, how much you can get by selling that. So that is salvage value. We use another terminology for the salvage value, that is known as residual value. In this chapter, we will be learning about three methods of depreciation: straight line method, unit of activity method, and declining balance method. And basically these are the methods which are basis for other types of methods. If you look into this expected value, this graph pie chart, you will find out that in US 83% straight line depreciation method is used for the plant assets. All other methods which you are not going to study, they are around 8%. Then 5% unit of activity method is used, and then the 4% declining balance method is used. So highly used method is straight line method. Let's move towards one example which we will be using for all these three methods. Barb's Flores purchased a small delivery truck on January 1st, 2017. It has some data. January 1st, 2017, he has purchased this delivery truck. At that time, the total cost he has incurred to purchase this truck was $13,000. This truck has an expected residual or salvage value of $1,000. It has an estimated useful life of 5 years. In years, it's 5. But we can also estimate the life based on activity, how much activity an asset can perform. It's a truck travels. So here activity for the truck is in miles, how many miles this truck can travel in its life. So they say that altogether this truck can travel 100,000 miles. We are supposed to calculate the depreciation under all the three methods, starting from straight line, moving on to unit of activity method, and then declining balance method. Let's move on towards the straight line depreciation method. Straight line depreciation method is known as straight line because the depreciation expense remains the same throughout the life of the asset. It does not change. How do we calculate it? We calculate it with the help of depreciable cost. What is depreciable cost? The cost of the asset which you have to depreciate. So cost minus salvage value, because salvage value you're going to recover at the end of the life. So remaining is depreciable cost. So how do you calculate it? Straight line depreciation is depreciable cost divided by useful life in years. So look here what we are doing. Cost is 13,000, salvage value is 100,000, so depreciable cost becomes 12,000. Now depreciable cost divided by useful life in years, 12,000 divided by 5, so the annual depreciation expense becomes 2,400. It's straight line, so every year annual depreciation expense will remains the same. We have a schedule for this. We can also do it with the help of the rate. So how do you calculate it with the help of the rate? So look here, we have 5 years. We purchased this asset on 2017 January 1st. So this asset stays with us for 2017. It stayed with us for 2018, 19, 20 and 21. So these are 5 years. Depreciable cost, we just calculated cost minus salvage value, so it was 12,000, right? Every year depreciable cost remains the same. Then the rate. How do you calculate the rate? There is a particular way to calculate the rate. We want to depreciate the asset 100%. If you want to depreciate the asset 100% over its useful life, so 100% divided by 5, that is 20%. Right? So rate is 20% for all the years because it's straight line method. Now annual depreciation. You can calculate annual depreciation with the help of this formula. You can use the rate to calculate the annual depreciation. So rate multiplied by cost, you get annual depreciation. Same answer you will get. Every year depreciation is going to be same. Then accumulated depreciation. Accumulated depreciation, consider it like a basket of depreciation. You put every year depreciation in this basket, and this basket accumulates the depreciation. Okay, so first year this basket was empty. So when you added first year depreciation to this basket, the balance become 2,400. Then second year depreciation, in second year you added to this basket. Second year depreciation was 2,400. Basket already have 2,400 from the previous year. So together previous year plus current year, I get 4,800 in this basket. Third year depreciation is 2,400. I also added this to the basket. The old balance of the basket was 4,800. We added new balance. So now the updated balance of accumulated depreciation is 7,200. Then fourth year we also added, then fifth year we also added, and by the end of the fifth year the accumulated depreciation balance is 12,000, and this should be equal to depreciable cost, because now we have depreciated the whole cost. So this basket should have whole depreciation in it, which is depreciable cost, 12,000. Let's talk about the book value. Book value means at any particular point in time or in any year end, what is the remaining value of the asset? What is remaining value? The cost minus how much the asset is already depreciated. So the formula is cost minus accumulated depreciation. That is book value. So at the end of the first year, cost is 13,000. Accumulated depreciation is 2,400. 13,000 minus 2,400, that is 10,600. At the end of the second year, cost is still 13,000, but accumulated depreciation is 4,800. So cost 13,000 minus 4,800, I get book value for the second year. And likewise we will do for third year, fourth year, and fifth year. Let's talk about the journal entry, how to record the depreciation every year, because this is the entry we have to pass at the end of the year to update the asset account. So by the end of the first year, which is 2017, what you're going to do, debit depreciation expense, because we have to report it in our income statement, and when we report expense we debit it. How much? Check out the annual depreciation, the first year depreciation, 2,400. So depreciation expense gets debit, and the same expense we add into the accumulated depreciation account. That accumulated depreciation gets credit. Accumulated depreciation is a contra asset account. Contra means opposite to its asset. So if we have equipment, accumulated depreciation on equipment is contra asset account for the equipment. So when equipment increase, we debit it. But when accumulated depreciation increase, we credit it because it's contra in nature. So that's why I'm crediting accumulated depreciation 2,400. This example was quite simple because we assume that we purchased the asset at the start of the year, which was January 1st. So asset stayed with us for full 5 years. What if you purchase the asset somewhere in the middle of the year or after some months? Like we will be using the same data set, but now we will assume that we purchased this delivery truck on April 1st, 2017. Okay, so when we purchased this delivery truck on April 1st, 2017, it stayed with us from April 1st, 2017 till 30th or 31st of March 2018. Then this was the first year. Then the second year was April 1st, 2018, and it ends on 31st March 2019. Then third year start April 1st, 2019, and it ends on March 31st, 2020. Then fourth year start on 1st April 2020, and it ends on March 31st, 2021. And then fifth year start on 1st April 2021, and it ends on March 31st 2022. That's why we have from 2017 till 2022 number of years. Okay, because 2017 the asset did not stay with us for full year. That's why we need some months from 2022 as well, so that 5 years are complete. Depreciable cost is going to be the same for all the years because the formula is not changing. The rate I explained to you, it's going to be the same because it's straight line depreciation. How do we calculate it? 100% divided by useful life in years. So for this example, useful life was 5 years. So 100% divided by 5, that is 20%. Annual depreciation is 2,400 for all these years. This is annual. Now from the annual, we will extract our per year depreciation. Because in 2017, for full year, for annual, asset did not stay with us. We purchased the asset on April 1st. So asset stayed with us in 2017 from April till December 31st. So April, May, June, July, August, September, October, November, and December. 9 months assets stayed with us in 2017. That's why I cannot use this 2,400 as a depreciation. I have to extract 9 months depreciation out of this 12 months depreciation. That's why I'm adding this partial year over here. 9 by 12. 2,400 is annual, means it's for 12 months. I need for 9 months, so 9 by 12. So my 2017 depreciation is 1,800. In 2018, assets stayed with us for full year, so no need for partial. The same depreciation will be recorded. 19 also same depreciation, 20 also same depreciation, 21 also same depreciation. But in 2022, the assets stayed with us until 31st of March. So January, February and March, only for 3 months. So 3 by 12. So my current year depreciation means 2022 depreciation is 600 because I have to multiply it with the fraction. 3 months it stayed with us out of 12 months. And then you can calculate your accumulated depreciation. Accumulated depreciation is the same basket. You keep on adding every year depreciation in it. How to record the journal entry? The same way. Debit depreciation expense, credit accumulated depreciation. Every year you're going to pass this journal entry. The current journal entry in front of you is for 2017. So in 2017 depreciation expense is 1,800. So that's why I recorded this. Let's move on towards the second method of depreciation, that is unit of activity method. Unit of activity method calculates the depreciation based on activity the asset performs. More activity it performs, more depreciation we charge. Less activity it performs, less depreciation we charge. So the companies, they estimate the total units of activity to calculate the depreciation cost per unit. The data set which we have, this data set has already the total unit of activity. Can you see? The estimated useful life in miles means the total miles this truck can travel, that is 100,000. So this is what we need for the calculation of depreciation under unit of activity method. So can you see? Companies estimate total unit of activity to calculate the depreciation cost per unit. So I have already total unit of activity which is 100,000. I need to calculate depreciation cost per unit. So you know that total cost, total depreciable cost divided by total number of units, I'll get per unit. And then we will calculate the depreciation expense based on unit of activity every year. We need depreciable cost. What is depreciable cost? That is cost less salvage value. Why I need depreciable cost? Because I need to calculate depreciation cost per unit. Okay. We have another terminology we usually use for unit of activity method, that is known as unit of production method. Let's move towards the calculation for the depreciation under unit of activity method. So here's the table for you. We are assuming that we purchased the asset on January 1st, 2017. the normal data set we are considering. So 5 years asset stayed with us. I'm telling you that we need activity asset has performed every year. So of course in the data we should provide you how many miles the truck has traveled every year. Okay, so this data will be given miles driven 15,000, 30,000, 20,000 every year. I'm telling you how many miles the truck has traveled. The method says I need to calculate per unit depreciation cost, and I need depreciable cost for that purpose. So let's calculate per unit depreciation cost. Per unit depreciable cost is equal to depreciable cost, total depreciable cost divided by total unit of activities. My total depreciable cost is 12,000. You know how to calculate it. Cost minus salvage value, right? Divided by total unit of activity, which is 100,000 miles. So per unit cost becomes 0.12. Now let's calculate annual depreciation. I know per unit cost 0.12 every year. I know how many miles, how much activity, how many units the truck has worked. So units multiplied by per unit cost, I'll get annual cost of depreciation. Okay, so 15,000 multiplied by 0.12, that is 1,800 depreciation expense for 2017. For 2018 it's 3,600. For 2019 it's 2,400. How did I calculate? By multiplying miles driven with the cost per unit. Okay, accumulated depreciation has the same philosophy. It's in basket. Every year you put the depreciation in this basket. Book value is also the same, cost minus accumulated depreciation. Every year you can calculate the book value. How to record the journal entry? No change. Depreciation expense debit, accumulated depreciation credit. Whatever is every year depreciation, you will be recording in this. First year depreciation is 1,800. So I put that. Second year depreciation is 3,600. So if you are recording the journal entry for second year, then debit 3,600 and credit also 3,600. The last method of depreciation which we are going to discuss, that is known as declining balance method. Why declining balance method? Because the depreciation declines over the years. Depreciation decreases over the years. In the beginning year, depreciation is more. The second year, depreciation is less than the first year. Third year, depreciation is less than the second year. So it keeps on decreasing. That's why we call it declining balance method. Another name we use for it, that is accelerated method. Accelerated method means in the beginning year the depreciation expense is accelerated. We charge more depreciation, and in the later year the depreciation expense is less. So as I mentioned, it's declining balance because the depreciation expense keeps on decreasing over the life of the asset. We will be using double declining balance method. Under the declining balance method, what is double declining balance method? Double declining balance method says that double the rate of straight line depreciation method. We calculated the straight line depreciation method rate in our previous question, where we were calculating the straight line depreciation. If you remember, look here, we did, it's 20%. We said that, right? So straight line depreciation method, we need to double it. So if we need to double this rate, we are going to multiply it with 2. So if I multiply the rate with 2, it becomes 40%. 20% was straight line rate, multiplied by 2, it becomes 40%. Now let's use this rate and calculate the declining balance method depreciation. Here is the table for you. For this method, remember, you don't use depreciable cost for the calculation of depreciation. You use book value for the calculation of depreciation. What is book value? Cost minus accumulated depreciation. This example, we purchased the asset at the start of the year, January 1st, 2017. So we have all the 5 years. Second column is about beginning book value. Then the rate for the depreciation, it's double declining balance method, so we'll be using its rate. Answer will be annual depreciation expense for us. Then we will have accumulated depreciation, and we need to calculate ending book value at the end of every year, because we need this for the next year as beginning book value. Starting with 2017, the beginning book value is $13,000. Why? Cost minus accumulated depreciation. At the start of the life, there is no accumulated depreciation. So beginning book value for the first year is exactly the cost, 13,000. Rate is 40%. So annual depreciation, if I multiply the rate with the book value, I get 5,200. At this time, accumulated depreciation basket is empty, so this is the first depreciation I'm going to add over there. Book value, cost minus accumulated depreciation. Now I will have ending book value for the first year. Cost is 13,000. Accumulated depreciation is 5,200. So 13,000 minus 5,200, I get my ending book value. This ending book value at the end of the first year becomes beginning book value at the start of second year, 7,200. Again, I'm going to multiply it with the rate. I get the depreciation expense for 2018. Now accumulated depreciation already have 5,200. I'll add this 3,120. So accumulated depreciation will become 8,320. Now I need to calculate the ending book value for the year. So cost minus accumulated depreciation. Cost is 13,000. Accumulated depreciation is 8,320. So I get the book value. Likewise, I'll be doing for third year and fourth year. Because we are doing the manual calculation, so in fifth year we will be adding a plug. Plug means we do the adjustment and then we calculate the depreciation. We don't calculate depreciation for the tabular form directly multiplying this rate with the beginning book value. No. We put the beginning book value, which is the ending book value of last year. We put the rate and then we come to the accumulated depreciation. Accumulated depreciation, as I mentioned before, its ending balance at the end of the last year should be equal to depreciable cost. So I put this over here, depreciable cost. Okay. Then if last year accumulated depreciation was 11,315 and this year I'm saying it should be 12,000 because this is the last, it should be equal to depreciable cost. So it increased from 11,315 to 12,000. Why it has increased? Because of current year depreciation, right? Accumulated depreciation increases because of current year depreciation. So how much increase? That is current year depreciation. So 12,000 minus 11,315, I get current year depreciation. So for last year, we'll be adding a plug. So if you see here, we have now all the 5 years depreciation with us. Every year we'll be passing the journal entry. It's declining balance method. Can you see? In the first year depreciation is highest, second year it's less than the first year, third year it's less than the second year. So it's decreasing, it's declining over time. Okay. What if you have purchased an asset in middle of the year or somewhere in between the year, not on 1st of January? So the tabular form will look same, but we will just add one factor, which is the partial year factor. Okay, so years I'm putting, then the beginning book value I'm putting, then the declining rate I'm putting. I'll be calculating annual depreciation like I tell you in the previous slide, like we just discussed. But then I'll be adding the partial year factor. So if we purchase this machine on 1st of April, so it stayed with us for 9 months in the first year. So 5,200 multiplied by 9 by 12. So first year depreciation is 3,900. Accumulated depreciation is 3,900 because there was no depreciation before. And I need book value column because we just discussed book value. So here in this table I didn't put it, but I want you to calculate it when you are doing it by yourself. So how you'll be calculating the ending book value? Cost minus accumulated depreciation. Cost is 13,000. Accumulated depreciation is 3,900. Right? So my book value at the end of the first year will become 9,100. And that will be the opening book value for the second year. And then I will proceed like we were doing in the previous one. Annual depreciation will remain annual because for 2018, 19, 20, 21 assets stayed with us for full year. But in 2022 we kept the asset only for 3 months. But again, this is last year, so we need to add the plug instead of doing the direct calculation. So this depreciation expense is not helpful for calculating the current year depreciation. We will be adding the plug. So how we'll be doing that? We will be putting the ending balance of accumulated depreciation, which is depreciable cost. Previous accumulated depreciation is with us, that is 11,820. The depreciation increases because of current year depreciation, which is plug, so 1,180. So like this we calculated the last year depreciation. So these are the 3 methods we use for calculation of the depreciation. Moving on, what if, because we said the life of the asset is an estimate, the salvage value is an estimate. Estimates could change, because if those factor changes which helps us in estimating these years or this salvage value, if those factor changes, estimation could also change. And what we do if estimates change? So then we have to revise the calculation of depreciation. Are we going to revise the depreciation for all the previous years? So the accounting rule says that if there is a change in estimate, then you will only change current year depreciation or current year calculations and the future year. Don't touch the past years, because in past also they were estimate. Past calculation are based on past estimates. Current year and future calculation will be based on current year estimates. So if useful life of the asset changes or the salvage value of the asset changes, then in that case we are not going to change previous year's depreciation. We will be changing the depreciation for the current year and for the future year. Okay, it's not an error, it's a change in estimate, and ideas or guesses could change anytime, right? We have an example over here. Arcadia HS purchased equipment for $510,000, which was estimated to have a useful life of 10 years with a salvage value of 10,000 at the end of that time. So 2 estimates we have: useful life 10 years and salvage value 10,000 when we purchase this equipment. Depreciation has been recorded for 7 years on straight line basis. So 7 years there was no problem. You was recording the depreciation using the straight line method. In 2015, which is 8th year, it was determined that the total estimated life should be 15 years. What we said before, we said 10 years. But now estimates are changed. They say it's 15 years. With a salvage value of 5,000. What was original salvage value? 10,000. New salvage value 5,000. What they want us? They want us, what is the journal entry to correct the prior year depreciation? I just mentioned, when the estimates change, we don't do the adjustment in the prior years. This is IFRS requirement. So there will be no journal entry to change the previous or the prior year depreciation. They will also want us to calculate the depreciation for 2015, which is 8th year. So let me tell you what will be the process. The process will be, in 2015, firstly we will calculate how much is the book value. Then we will say this book value is our new cost for the equipment. And then we will be using new life and new salvage value for the calculation of depreciation. Okay, so let's do this. Let's calculate what is the book value first. So how you're going to calculate the book value? The formula for the book value is cost minus accumulated depreciation. Look at this table. Cost is 510,000. It's given in the question, but accumulated depreciation is not given. So let's calculate accumulated depreciation. How do you calculate accumulated depreciation? Accumulated depreciation is annual depreciation altogether. 7 years are gone, so 7 years annual depreciation. We also do not have 7 years depreciation. So let's calculate annual depreciation and then multiply it with 7 to get our accumulated depreciation. So annual depreciation is, under straight line method, we just looked at the formula, cost minus salvage value, you will get depreciable base. So cost is 510,000 minus 10,000, depreciable base becomes 500,000. Divided by useful life in years. What was useful life initially? 10 years. So annual depreciation, which we have recorded for 7 years, that is 50,000. We need accumulated depreciation, 7 years depreciation together. So I multiply it with 7 depreciation, so I get my accumulated depreciation of $350,000. Now I can calculate the book value, right? So what is book value? Cost minus accumulated depreciation. So cost is 510,000, accumulated depreciation is 350,000, so the book value becomes 160,000. Now I will consider this book value as a new cost for my asset, and the new calculations will be based on this book value. So this is the cost. I need to use straight line depreciation method still for the future. I have a new salvage value. I have new total life of 15 years, but don't forget 7 years are already gone. So out of 15, if 7 years are gone, what is remaining life? That is 8 years. Now let's calculate the new depreciation based on these parameters. New cost is 116,000 minus salvage value. I get depreciable base of 155,000. How much is remaining useful life? 8 years. So if I divide it with remaining useful life, now new annual depreciation for the rest of the life is $19,375. So in 2015, I'll be recording this journal entry: depreciation expense debit, accumulated depreciation credit, 19,375, and this will be for the future years as well, until and unless the estimates changes. Okay, so let's revise quickly. In order to calculate the depreciation under the revised method, firstly you calculate the updated book value. Once you get the updated book value, then you use the new parameters to calculate the new depreciation. And this is it for the second learning objective. Hopefully we will continue from the third learning objective in the next recording. Please listen to the next recording if you want to continue the same chapter with me. Thank you. See you. Bye.